The market's first reaction was to the headline, and the headline tariff was obviously something which was more like a shock and awe kind of effort by the US, primarily to make the world draw their attention, and I think that is behind us.
Given the trade worries, are you opting for more India-dominant plays rather than companies that have more US dependencies?
Tactically, yes. At this stage, we are probably more open to taking domestic risk rather than taking global risk, because domestic risk, I think it is more manageable.
So, what should be an ideal asset allocation for investors within equities and within asset class?
So what we are toggling is not between fixed income and equities. As of now, we are toggling within equities itself.
Would India see more foreign flows as compared to other markets, probably? Hello everyone, meet Taher Badshah. He is the CIO of Invesco Mutual Fund, who has skin in the game for more than 30 years now. From value to growth, he's seen all the market cycles and knows how to stay the course. So, hello sir.
Hello.
How should investors navigate this current situation in the market? We've seen that when the US imposed tariffs, there was a global sell-off, and then a pause thereafter brought some recovery in the markets. There was a breather. So how should investors look at it? Like, is the uncertainty behind us, or should they wait for a bit and then enter?
So you can never time all these kind of things, and especially this kind of a development, which is once again a once in 100-year event, more or less. I mean, it is almost like COVID. This scenario last happened sometime in the mid-30s, 1930s. So to that extent, again, at one level, it is similar to the uncertainty that was brought about by COVID. Though I would say that COVID was relatively more complicated, because at that time we were struggling with our lives, not just our livelihoods. And therefore, this is perhaps going to be easier for humanity to probably navigate, and investors also to probably navigate. But it is something which is still quite defining and quite material from the perspective of global trade and commerce. One very large, and not just very large, the largest enterprise on this planet is actually trying to do some things differently compared to what they've been doing over the last many decades. So obviously it will have its repercussions. You are trying to change a little bit of the world economic order, and it's not only the economic order. Alongside which, there are several other things which are intertwined, which they want to probably settle along with the trade dynamics, whether it be immigration, whether it be drug control, whether it be geopolitics, depending upon which country and which region you're talking to. So I think there are a lot of embedded forces which are at work, and that makes things a lot more complicated. However, as it stands today, I would like to think that the market's first reaction was to the headline, and the headline tariff was obviously something which was more like a shock and awe kind of effort by the US, primarily to make the world draw their attention, and I think that is behind us. The damage caused to it by that approach to the market is also, to my mind, the bulk of that damage is behind. I think these things will now move to the next stage. The next stage will basically be about more rational dialogue between nations and collaborations. That is what it will move to. There will be assertions by the US in order to get as much as they want, but I think it will be less nerve wracking than the first reaction and the first round of news flow and approach was. So I think there will be still some volatility, perhaps of a lesser order compared to what probably happened in the first round. And that volatility will coincide with the negotiations which happen. I also don't think that this will be a very long drawn affair in terms of time. So it's not that it will extend into the whole of 2025. I would like to think that even the US as a nation and the administration out there is trying to ensure that this is concluded at the earliest, so that whatever benefits they have to derive out of this are put into action, whether it is in the form of benefits in terms of manufacturing, or whether it is in terms of reducing the deficit, or whether it may even be in the form of collecting more revenues which they can recycle back to the US citizens. All this they would want to kickstart as early as possible, and obviously the administration has a 4-year tenure as we speak, so they would like to, make some of those benefits seen visible during their tenure. So I think to that extent, therefore, I don't expect it to be very long drawn. And headlines in the market would shift probably in the course of the next few months away from tariffs onto other issues.
Do you see any winners and losers from this tariff war for India?
Plenty of them. I mean, it all will be a function of how well does India play its cards and in terms of negotiations. But more than that, I think it will also be about how India gears up for those opportunities which come through. It will all depend at some level on final tariff, as to where they finally lie, not just for us, but even for the other countries, and how advantages is that differential, whether it is between China and us or whether it is between Vietnam and Bangladesh with us. And so on and so forth. But I think there are obvious categories of products and segments and industries where we can look forward to getting some advantages. Electronic manufacturing definitely being one. The other being in the area of textiles, chemicals is another. Pharmaceuticals should be a continuing area where we will continue to get boosted. I think we can explore options with regard to our oil and gas imports and whether we can probably optimize this for ourselves, even though we have largely relied on our Asian partners or on this side of the world in terms of our requirements. But can we explore a more stronger engagement with the US because we are an energy deficit nation? So we should, it may not necessarily benefit any one particular sector, but it could be to India's all-round benefit across different sectors because energy is consumed everywhere. So if we can use this in order to ensure our sources of energy and perhaps if possible even bring down the cost of energy for ourselves, that is also going to be welcome. So I think there are quite a number of sectors where we probably can have an important role to play. Look, from an US perspective also, if you look at it, while they have a confrontation with China and they will try to resolve a few of them. But additionally, I mean, when we think of it from the next 25-year perspective, they would want to get to a situation where they can identify a more reliable trade partner over the years, over the coming next 25 years. Maybe the last 25, 30 years, they've relied on China as a willingly or unwillingly, they've relied on China to satisfy their requirements. I think from a geopolitical standpoint and even otherwise from an economic standpoint, they would want to create another beachhead. So I think that plays very well from the point of view of India, uh, given that it can take on that mantle of manufacturing. It has at least the worker base or the labor base which will be required in order to get that scale of manufacturing. Of course, lot many things will have to be done by India as well in order to make that happen. But at least as a starting point, uh, this is we stand out as a nation in terms of the alternatives that even in the US would probably seek for its own self.
Given the trade worries, do you see that are you opting for more India dominant plays rather than companies that have more US dependencies?
Tactically, yes, maybe these are shorter term, moves, portfolio moves that you would probably want to do in order to kind of, uh, manage this somewhat uncertain time period where you don't really know. You have a fair idea about what things are going to look like, but you still don't know exactly what it would probably be in its final shape and form. So yeah, I mean, in the more recent past, we would have probably, I would say, a couple of months, we would have probably tried to prefer some of the Indian or domestic opportunities. Even when we want to be defensive, let's say, for example, would you want to get your defense? Generally, traditionally, pharma, IT services, even though they were kind of global sectors, they tended to be defensive sectors in a way because typically these were businesses which were high on return on capital. They were free cash flow oriented companies. They had some decent growth within them, and generally they were consumer facing or service led businesses. So it was easier to think of them as defensives. But today they are all of them are not. Maybe tech today is in a stage where it's not behaving like a defensive anymore as well, despite the fact that some of these companies still remain very profitable, but they are in the throes of this whole new dynamic which is emerging. So it's difficult to think of tech as a defensive, but can I think of pharma as a, even despite it being a global sector, can I think of that as a defensive? Perhaps yes. So I would go to non-domestic sectors, but to the extent we can probably feel confident that they can give that defensive characteristic to the portfolio.
Like the measured risk you spoke about.
Like the measured risk that exactly that. So I mean, we try to balance that portfolio in a way such that we are taking certain. I'm at this stage we are probably more open to taking domestic risk than taking global risk, because domestic risk, I think it is more manageable. I think I'm happy if I can go wrong there, because at least then at least it is not about not knowing. I knew and we know about it, and get if we go wrong, we can rectify. But if we're dealing with sectors where you in any case as a starting point don't have a great handle on it, there are several forces which are at play, and you don't know exactly how it goes. And then if you're trying to take some risk out there, it becomes compounding of risk. So I think. Uh, in that sense, therefore, we would prefer some of the domestic stories at this stage. But there's an evolving process. I mean, this may not be something which is very long lasting, maybe 6 months, 12 months down the line. And by the way, again, to come back to that part that, I'm wearing a double dual hat. So there might be some sectors which we don't like at this stage, but those are exactly the sectors which I would probably want to think when I think of from myself as a value fund manager. And if I'm looking at in the Invesco India Contra Fund, for example, then I would like to represent some of those ideas, especially if they are beaten down, they're ignored, they are they are facing headwinds, and valuations are probably also come down. Growth visibility is poor. These are exactly those circumstances in which you represent some of these sectors or bets or stories or companies into your contra fund. So my growth fund probably might sell, but that same idea might be probably relevant for my value strategy. So I think I don't now have the liberty to dismiss one sector forever, saying that no, I will not go anywhere close to it. Depending upon the mandate and depending upon what makes sense to each of the strategies, we may have to probably take the calls. But yes, I mean, even then, having said that, current scenario is such that, yeah, I mean, if I can find a value opportunity in the domestic context, I'm more happy to do it than finding a value opportunity in the global context.
From a medium risk appetite perspective, you're also heading the fixed income side. So, what should be an ideal asset allocation for investors within equities and within asset class?
So I also over the last few months I've been running our multi-asset fund as well. We did an NFO approximately 5 to 6 months ago, and we tried to configure that portfolio. We tried to create a structure for ourselves where we could adequately represent 3 or 4 asset classes and not just give lip service to them. So make them reasonably central in terms of asset allocation, whether it be gold or whether it be fixed income or whether it be international securities. So I think going by the experience of running that fund, although over a very short period of time, but I think at this stage, we have, and speaking immediately over the last few weeks, we have actually moved some of our allocations to India equities from international equities. So in terms of risk appetite, again, we are trying to basically manage that risk appetite. We had a higher level of risk appetite just before the Trump trade war related rhetoric started, and the picture in the global markets was looking seemingly more clearer than India. Suddenly things have reversed in the space of a very short period of 2 odd months. So we've now started, not now, but over the last 2 3 weeks, we had unwound our overweight on the international markets in favor of the India markets or domestic equities, simply because we'd seen underperformance here, we had seen outperformance there. So I think at this stage, I'm more willing to take risk on, even though it is still not a very clear, horizon. I'm willing to take more risk on the domestic portion, like as I said, and I'm probably going to be a little more risk averse as far as international equity is concerned. From a fixed income perspective, we are at the same level as where we started off 5 6 months ago, but we are not giving it up for any other part. So what we are toggling is not between fixed income and equities. As of now, we are toggling within equities itself. So from international to domestic or domestic to international. So fixed income and gold by and large have been the two pieces which have anchored ourselves, and that to my mind, I think provides a good bulwark against risk. And then we are trying to take that risk on the other side between the within the two parts of the equity ecosystem, whether it is international or domestic. And if we do it well and toggle well between even these two asset classes, so I think in doing all this, at least there's a very short period of time, but in the last 5 6 months, amidst all the volatility that we've had, at least our multi-asset fund has stood up well, and we've not lost here or there. In fact, we are by and large at parity since the time we launched our NFO. So that's a good, happy situation to be in a market which has been so much full of turmoil.
Would we see more foreign inflows? Would India see more foreign inflows as compared to other markets, probably?
Probably, I think we should see a reversal of flows, at least that very dull picture that we saw on flows over the last 7 to 8 months since about August, September of last year. I think that by and large, that once again, that bulk of that hit on account of outflows, a combination of India's own making and to some extent the global backdrop seems to be behind. We started to see flows stabilize a little bit over the last few weeks. I think the way things are likely to emerge and the way we can, to whatever extent we can foresee things unfolding over the next 6 to 12 months, it looks like we should see reversal of flows as U.S. markets undergo phase where uh, from a very near term perspective, we feel that earnings cycle in the earnings upgrade cycle or the earnings cycle in the US by and large has peaked out. And in India, probably the downgrade cycle seems to have bottomed out. So if that is the case, and valuations at the margin have somewhat become a little more comfortable in India and in emerging markets in general, I think flows should revert. It also might be supported by dollar weakness and as well. So I think if that happens, then flows should strengthen. Even when we look at, and if we don't look at the more aggregate picture, but when we look at our own clients and our engagements with offshore investors, we also have a reasonably decent offshore business that we run. I think we are seeing increased amount of interest out of several parts of the world in engaging with Indian asset managers and looking at India as a market. So I think principally India should be a recipient of flows. And even cyclically, I think we are in for a change. The only difference I see in this upcoming round of flows in, let's say, over the next couple of years versus, let's say, what happened in 23 and 24 is that when flows start to resume towards Asia or emerging markets from DM to EM, I think this time around China will also be a fairly decent contender for those flows. It was not as much in the reckoning in the last instance because economy, they found it difficult to significantly revive despite all the stimulus, and domestic factors kept the lid on the markets out there and valuations. But I think after DeepSeek and the Chinese economy is now being looked and assessed differently by investors compared to what it was in the more recent past. They are more inclined to take a favorable view, as we understand. Think of them differently versus the past. Not just look at them from a perspective of either an investment-led economy or a consumption-led economy, but look at them more from the perspective of even a leading-edge player in technology at various levels, whether it be in artificial intelligence or robotics or medical sciences and so on and so forth. So uh, if that being the case, and then in any case, the market out there has always been cheaper than many other economies and many other markets around the world. So I think this time around there is a fair possibility that the flows will be divided between us and China and a few other countries. We may not necessarily get the lion's share of incremental flows as we go along.
So even the IPO market has gone cold and ECM deals are also probably getting stalled or reworked. So what does that leave on the table for institutional investors? Do you see both value and growth there?
In the IPO market, you mean?
Yeah, IPO and the blocks trade.
Yeah, I think that activity will, again, these are parts of, these are cyclical elements, and we have those very strong bouts of, enthusiasm, and then there always comes a phase where things start to kind of lie low. So I think we will probably go through the next 12 or 15 odd months where it will be more of the very high quality offerings, which will probably, if at all, if they hit the market, will do well. But they will also be a lot more reasonably priced, hopefully, compared to what they have been in the past. It'll be, to some extent, in fact, from an institutional investor perspective, as you ask, it might probably become easier. Life becomes easier on two counts. One is that you don't have to be bombarded with 20 IPOs in a month, and the other being that they also come at more saner and rational valuations. So I think then your chances of make some returns or probably even controlling risk is better. But this part will still be a very active and live part of the Indian economy going forward, because many startups have been cultivated over the last decade or so. Few of them are obviously reaching a stage where they met with a certain level of stature and success, and obviously they would now want to reach out to the broader market. So we will see that we are obviously, economic landscape keeps changing and new elements keep coming. Some of the old sectors also get revive at times. So whether it be the power sector, for example, or even chemicals for that matter, they have been out of reckoning for some time, and now hopefully they might probably see an upturn. So I think that all will lead to higher levels of capital activity in general. Perhaps it will be cyclically a little softer compared to what it has been in the last 2 years. But investors will have the chance to be a lot more choosy, um, and perhaps even the scales will shift in favor of the buyers than the sellers. And that's a welcome sign. It should probably lead to better quality returns out of these investment propositions over the next few years.
So one bit of advice to investors from your, past learnings and experiences that you've picked along the way.
What I'll probably say is nothing new, but we all know that there are these elements of fear and greed, and if we are not at the extreme end of the fear gauge, we are somewhere in the fearful mode, and we've just walked out of the greed mode, and it will therefore take time for investors to probably get adjusted from one climate to another. But I think it's nice to have a fear mode at some point in time or for some time, because it in hindsight, it always enhances returns. Many of these situations which arise, whether it was even something as overwhelming for all of us like COVID, uh, turned out to be a blessing in disguise in many ways. And we've all seen what the market has done post that in the last 3-4 years, not just for India, but across the world. And like I started off by saying that, COVID was a lot more severe compared to this challenge that we face. So I think investors should rise to the occasion at times when, if you've gone through the long cycles, then you know in your heart of hearts, in your gut of guts, as to what is the extent of fear which is already embedded in the market. And then you don't necessarily have to be a genius at investing to be able to kind of make some decent money put to work and enhance your overall aggregate returns, because things do come around, and generally the world is not such a bad place, and things don't turn out to be as ugly in the short run. We obviously overestimate bad things and we underestimate good things, as they say. So I think you should, for investors, it should, all these sharp dips or sharp corrections in the market, take a deep breath and do not fear it. Try and face it. We might have to probably be a little more patient, but at times, if you are capable and if you have money to invest, and if your equity allocations in particular are not full up, you should make some moves to take some measured risk. Not necessarily commit everything at one go. Break it down, because we still might have, this story is not fully
Played out.
revealed itself. So it will, but like I said, the volatility in the next round hopefully should be much lesser than the previous, and in the third round it should be much lesser than the second one, and so on and so forth. And then a time will come when that will move away from the headlines, and even Mint will probably move to a different set of headlines by then. So I think the world will keep changing, but I think some of these opportunities in hindsight have generally proved to be 8 out of 10. They've always proved to be return boosters. So do take some advantage out of it and try and maximize our opportunity.
It was a pleasure chatting with you, sir.
Same here. Thank you very much.
Thanks for tuning in. And I hope you enjoyed the conversation as much as we did. Until next time, happy investing.